Welcome everyone to Investing for Generational Wealth. Let us dive in to the world of expert financial insights and strategies. We're your hosts, Keshav Kalor and John Lai, and welcome to today's episode, Commercial Real Estate Capital Markets with Edward Gray. Before we begin, a quick disclaimer: we are not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So please perform your due diligence before making any financial decisions, and of course, consult your CPA and your attorney before beginning investments. Today's guest is Edward H. Gray, a seasoned professional in the world of apartment finance. With over 20 years of experience, Edward's expertise includes navigating the landscape of private client and middle market apartment financing, with a deep understanding of the intricacies of Fannie Mae, Freddie Mac, HUD, and bridge loans. Throughout his career, Edward has been instrumental in facilitating a myriad of transactions, cumulatively exceeding $1 billion. Thank you for being here with us today, Edward. We gave a bit of your background on experiences, but could you provide some more detail on your background and how you got to where you are today?
I'm going to bring with you everywhere I go, so I like walk out and just have you do that real quick for me. Everyone gets to know who I am. That's fantastic. So I'm Edward. I'm a director with Limit. I specialize in Fannie Mae, Freddie Mac, HUD, and bridge loans. We work nationwide. Our business is based on helping the private client and middle market apartment owner, achieve their financing goals. Sometimes there's some creativity, and then other times it's, real meat and potatoes, and we like to do both.
Sounds good. Yeah, thank you for that. And with that, you have a presentation prepared for us today, so let's jump into it.
Right on. Let me hit the share screen button. And all right, am I sharing the screen? We're good?
Yep, you're good. You
Excellent.
hit presentation mode though. I think this is practice
You
mode.
want to swap? Yeah, do you want to swap screens?
Yeah, there should be a different window.
Which window is that? I'm sorry, guys.
We see a window with the actual slide and then the speaker's notes.
You see the next slide?
Yeah, we see
Hold on.
the next slide. Yeah,
Oh, the next slide, yeah.
and all the notes that you're cheating with.
I don't think there's any notes I'm cheating with. I'm not saying there's not, but I don't think there are. Is that presentation mode?
I think the display settings, you might be able to swap the up top. Go further up, there's a menu item that says display settings.
Guys, I'm sorry. I thought we had me under control.
You're good.
No, that's good.
Yeah, if you could scroll, just go a little up to where it says display settings.
Oh, there we go. Display settings.
And then swap,
Yes.
yeah.
If you want.
There you go.
Perfect. All right. So today's pretty basic introduction to commercial real estate capital markets. And think about it. There's two primary ways we do a deal, right? Debt and equity. Equity is what your money is, the debt's what the lender puts in. And so real estate projects are, they're a mix between debt and equity. And the question always is, why would you want to borrow? How much borrow? How do you get that right? So, why would you do a deal using debt versus equity? Debt juices your return. If you buy a deal for $100 versus 10% in cash, $10 in cash flow, it's a 10% return, right? Pretty straightforward, easy math. State school guys like me can even figure that out. When you switch to adding in debt at say 80% LTV, you're able to juice your return to 18%, which would be 80% more. And that $10 you're receiving is now only $3.60 because you've given $6.40 of it over to the nice lender, me. Real simple numbers. So, debt can both juice and hurt returns. If you think about, a swing of 20% up or down, the return could be 8% or 28%. So figuring out how much debt to use is the key to all of this. Debt's neither good nor bad. It's just a tool. Too much debt, put yourself at risk. Not enough debt, suboptimal returns. So just how much is the question as you think through, what's our strategy? How are we going to own this asset? What are we going to do? It's just how much. This is just real quick about, different terms people talk about. A mortgage is an actual, secured by deed of trust. It's what owns the asset, very straightforward. People often talk about, mezzanine debt, which is secured by a pledge of the partnership interest, or you'll hear very, new terms. Everyone's very excited about preferred equity, which is, literally in the partnership agreement, it's, preferred equity, just 3 different levels of it. And as you move out from, a first mortgage to a second or third mortgage into mezzanine and to preferred equity, the returns, theoretically go up, but so does the risk as you move out each slice. All right. So this is where we start to get into kind of the thoughts on the capital markets world. Who provides the money, and how does that work? There's numerous sources of money that you can use to provide debt to a deal. The first one is a credit union. Credit unions are nonprofit organizations. They are funded by deposits received from their members. Credit union loans are generally going to be a short-term loan because they are funded using member deposits. The beauty of them, again, is they're nonprofits. They generally will have the best rates available of anyone on this sheet. They are a full recourse lender, which means you will personally be signing that loan. And if something goes wrong, they'll be going after you personally. Next up, commercial banks. Very similar to a credit union that they're funded by depositors, but the difference being, commercial banks are obviously for profit. Whether it's, a Goldman Sachs, a Capital One, your First Federal in your town. There's, numerous commercial banks. Again, bank loans, full recourse. So again, that means if something goes wrong, they will come after you personally. One of the great things about most of the commercial bank borrowing is it's done on a relationship basis. So the lenders that you work with, have an ability to work with you much easier. And as we go further down the sheet, you get into, much more programmatic lenders. Most bank debt's going to be 3 or 5 year paper. Some banks will go to 10, but remember the issue that you see banks face as they go longer is that they're borrowing short to lend long, so they can find themselves caught, when rates move inversely to them. Next up, insurance companies. Insurance companies are a fantastic source of long-term debt. They're the first of the non-recourse lenders on this sheet, which means if the loan goes bad, they're only going to take the property back, not come after you personally. Insurance companies are a very unique way of funding in that if you have life insurance, your life insurance premium goes into insurance companies. And one of the things they do with that money is write commercial mortgages on properties. And so they have an ability to lend, long-term. They're looking at their actuarial table, which is a fancy way of saying when they think that you and all of their clients are going to die, to write their loans. And so they're trying to match the term of their loans, to the expected life of their policies. So it's a really neat way that they're able to fund. They're able to do longer term loans. Generally, life insurance companies lend on higher quality assets. Generally the higher end of middle market institutional deals, generally nice deals, because they're there for a long time. Very unique in that sense. So now we're getting to the part that's nearest and dearest to my heart, the government sponsored entities. That's, the Fannie Mae, the Freddie Mac. They have mission-based lenders, and our mission when we're working for Fannie and Freddie is the expansion of affordable housing nationwide. One of the interesting facts is that when someone comes to me with a beautiful brand new property, what we call a Class A, I will give them a worse rate than I will give to them on an older workforce property, because the fact I'm looking for that workforce property to satisfy our mission. It's really unique in the way that that works. Most Fannie Mae and Freddie Mac loans are 10-year loans, but we offer everything from, floating rate loans that can be repaid at any time to, a 30-year loan with a 30-year term. So Fannie and Freddie have a great ability to do a lot of really cool things, in the multifamily space, non-recourse, love the product. My next product that, again, near and dear to the heart, HUD FHA, they are literally, they say, the government. Frankly, I think that HUD offers the best loan in the world, but in exchange of that best loan in the world, they put you through a ringer, and a HUD loan closing will take somewhere between 7 months, what we call a 223F, which is a refinance, to 13 months for a 221D4, which is their construction loan. So in exchange for a beautiful loan, it takes a long time. Next up on the sheet is CMBS, commercial mortgage-backed securities. Very inflexible. I have a history doing CMBS loans in New York for an investment bank. Basically it is going to be a 10-year loan with 9.5 years of prepayment on a recourse basis. And if you need to make any changes to your loan, you're going to have a hard time because they aren't known for their flexibility. It's just not what CMBS does. I don't see anybody pop up with any questions, but John, Keshav, y'all have anything before I move to the next slide?
What are some maybe typical use cases, not use cases, types of projects?
No, that's actually a fantastic question, right?
Like,
so if you're buying a, sorry, go ahead.
And which one's better for which?
Yeah, so if you're buying a property that's going to need, substantial work, you're probably going to want to buy it with a commercial bank, or someone like that is going to offer you a short-term bridge loan to do work on the property. And so, commercial banks are, fantastic options for short-term lending to reposition a property, to add value to the property, and then look to someone like Fannie Mae or Freddie Mac for the cash out refinance to reposition it. That's a pretty standard, great use of, bridge to perm, so commercial bank to Fannie and Freddie. That's a great thing. And we do that all the time, help people go from a short-term loan to a long-term loan after they've added value. All right. So the next question people often ask me about is underwriting and, underwriting parameters. So the key thing about that is underwriting parameters change by lender. They are not universal. A credit union's underwriting parameters versus commercial banks' underwriting parameters versus Fannie Freddie underwriting parameters versus HUD. They're all very different. And even Fannie Mae and Freddie Mac, while they're both, GSEs, both have different underwriting parameters and styles of underwriting. And so if you're, borrowing an agency loan, it'll be underwritten to, DUS or seller servicer guidelines. Luckily my employer, Lumen, has both Fannie and Freddie if you need one. Keshav said not to sell too hard. Conduit loans, which is the CMBS loans, 100% focused on the cash flow and the collateral, because you're going to take, a big pile of loans, roll them up together and sell them as a pool. So, Fannie and Freddie and CMBS sell their loans pooled to investors. And so, they're very focused on what they're getting, on a stabilized basis. Portfolio / balance sheet lenders, kind of going back to Shav's question about, bank lending. Balance sheet lenders are much more flexible because they're holding on their own balance sheets. They don't have any investors that they have to answer to. And so it allows them that, if your business plan changes midstream, you can reach out to your lender and say, hey guys, I no longer want to, upgrade half the units. I want to upgrade all the units because I'm getting these great changes in my rent. And a portfolio lender like, yeah, that's cool. No problem. Let's do that. Here's some extra money, sign some new docs and you're off to the races. Conduit lenders are not nearly flexible like that. They sold the loan, there's investors involved, and it kind of changes their ability to sell off a loan. So common loan types. And for anyone at home, there's going to be a million of y'all. Feel free to throw questions in, or at the end, we're going to do question and answers. The three main types of loans we're going to focus on today are construction loans. Very simple. It's exactly what it sounds like. It's a loan to build something. At Lumen, we have with our own money and HUD's money, which we use to do construction loans, but most construction lenders are going to be commercial banks. That's where the vast majority of construction financing comes out of, is our commercial banks. they're good at it. And you would look to someone like, a Lifeco or a GSC to do a refinance to take you out after the property is built. So that's, construction to perm, sometimes called mini perms, but taking you to the perm loan. Very much in the news today for a lot of people in the syndication community who are out buying deals. They've recently been buying deals with bridge loans. And bridge loans are exactly what it sounds like. It's a bridge from point A to point B. And so the thought being that you're going to buy the asset with one set of financial performance, bridge it, increase the value, and refinance it out. That's how, as we've seen people as of late, generate wealth, is through the value add process. And part of that is the bridge loan, which shorter term, how we get people from point A to point B. Unfortunately, as we're seeing in the news a lot today, bridge loans are showing kind of the risk of taking a short-term loan when interest rates can rise and run and change. Again, there's nothing wrong with a bridge loan. You just need to make sure that you're properly underwriting it so that it fits your business. John, you got any questions on this one?
Yeah, I had a question with the bond yields rising recently, really spooks Wall Street investors and drives down the broader S&P and Nasdaq markets. And without a crystal ball, how much more and how much longer do you think the Fed will keep either the interest rates where they are or raise them? And then how does this interest rate fluctuation affect the attractiveness of the commercial capital markets?
So I jokingly always say when people ask my prediction on interest rates, let me tell you how I made my first billion. In case you're curious, I have not made my first billion. So this is literally just a guy just talking. But interest rates right now are in this weird spot where the short end of the yield curve, like SOFR, the 30-day rate, is substantially higher than the 10-year rate. And so, in what world would you say to yourself, I'm only going to take, 4.75% to lend money to someone for 10 years, where I can get 5.3 for only lending to for 30 days. You have much greater liquidity. So there clearly is some pain and changes coming in the interest rate market. I have no idea where they're going to look like. I mean, if we could work that interest rate curve, that'd be fantastic because we could all make a lot of money. But the beauty of our current situation for the apartment investor, apartments historically been a really good inflation hedge. And as inflation continues to run, apartment rents historically have outrun inflation. So it's been a good place to place money, in that time frame, and that you can, hopefully be on the other side of inflation. As far as whether the Fed's going to lower or raise rates next up, again, clueless to that. It's one of those kind of impossible questions. But I think the Fed has told us is that they're not to be trifled with, and they aren't going to back down until they see inflation come in line. So for some foreseeable future, I think I see the Fed being pretty, hawkish on interest rates and not softening up. When that policy changes, it could be 60 days from now if, economic news isn't as positive, or it could be a year from now or 2 years from now or 10 years from now if they're unable to get inflation in check. That's my half-hearted guess.
A follow-up question to that, which is, I think it makes sense on the supply side for capital markets that you want to supply more short-term rates or short-term loans rather, because the rates are so high. On the demand side, as either syndicator or someone that's investing hopefully long-term, or maybe even for a flip, how do you play those bets? Let me just ask that initially. How do you play those bets, knowing that interest rates are pretty high now? Who knows what's going to happen in the next 180, 365 days or so?
Yeah, I just think that on apartment investing, we should always start at the opportunity, right? There's always someone who has a loan maturing that they don't want to renew for a period. There's always, partners who are no longer getting along and they're splitting up. In that same vein, there's always someone getting divorced, needs to get liquidity, and so some assets are being sold due to a divorce. And in the worst case, there's death, and we see a lot of estate sale deals. And there's always opportunities to find deals. And I think that the most important thing to do is focus on the opportunity to transact not on short-term, interest rate things. There's, probably all our parents are baby boomers, and as they retire, there'll be great opportunities to buy apartment complexes from baby boomers who want to retire, no longer manage an apartment complex. And it's gonna be great opportunities. I think that's the thing to focus on, is the opportunities you see in markets, whether it's developing a build-to-rent community in a place of high job growth, or finding a property that someone's been mismanaging and you can come in and add value on. I think that's the thing to focus on, not interest rates 90 days from now, because we have no idea. Apartment complexes aren't particularly liquid. When you have a hard time selling one, it tends to sit, and so you need to be able to ride out a storm. I don't know if that answers your question at all, or if that was just me just babbling at you. That's kind of my thought.
That's great. That's perfect. Thank you.
No, I got a couple more slides. There's not a whole bunch. I promise it's in like a 6-hour thing. It's kind of, what are the key things that you need to look at? Like, how do I underwrite a deal? And, kind of 3 key documents, the rent roll, the operating history, both for the trailing 12 months, which we like to see on a monthly basis where possible, and historicals for the last couple of years. And last but not least is your budget / pro forma, which allows us to see how you plan on operating the property in the future. This is roughly this is what a rent roll looks like. It, unit, tenant, rent, when they moved out, security deposit, when their payments are due, just kind of gives you an idea of what a rent roll looks like. Next up, a T12, again, pretty straightforward document. Income at the top, working your way down to total income, expenses beneath it, working your way down to NOI on a monthly basis from left to right. And so we can look at variance between months to see what was spent in any given month and how things are going at the property. This is kind of the heart of the deal, is the T12 on a monthly basis. It's the key document we need to start looking at underwriting a deal. Kind of these some key terms real quick. Income, which is just revenue, money in. Expenses is money out. When you subtract expenses from income, you get to an NOI. Hopefully it's a big positive number. We all like big positive numbers. Next up is debt service, which is your lender each month. After that, cash after debt service, which is what you have available to give your investors, right? So we all want as much as we can from that number. Cap rate is just, we get backwards, the inverse of your purchase price and the return on a percentage basis it provides. Loan to value is the property's, how much of a loan you're borrowing against the purchase price. So if you borrow, $80 on a $100 purchase price, you have an 80% loan to value. Next up, debt service coverage ratio. We always write an X at the end. That's the coverage that you have after paying your debt. We usually want to see at least 25% more money available in case you have a slow month, make sure you can still make your mortgage payment. Debt yield is the concept of the lender's cap rate. So that just takes the NOI to the loan amount. Not sure if anyone has any questions on this one. This is kind of one where it starts to, people have questions. John, got anything on this? Keshav?
Go ahead, Keshav. Keshav, ask your question again.
Yeah. What do you, Edward, what do you usually look for on debt yield right now, at least?
So we use debt yield the most on our bridge loan products. And so, we probably like to be solving for an 8 or better debt yield. That way we know there's be plenty of room to refinance out the debt. That's kind of, 8 or better is kind of the debt yield number we're looking for right now. But, switching property types completely, if you were to be working on, say a Staybridge Inn and Suites, a hotel in a secondary market, you may be looking for, a 13 debt yield. And so it very much, changes by property type. I live and breathe apartments, but for friends that do other things, debt yield very much matters. We're much more concerned in our space on loan to value and debt service coverage. And with the change in values we've had in the last couple of years, very few deals do we actually care about loan to value. We almost always care about debt service coverage ratio, because all the deals have tons of value, where they get, hemmed in is on debt service coverage ratio.
And this metric debt yield, you said it's similar to cap rate, and in that sense, it would fluctuate. Does it fluctuate based on market and the asset class?
Yeah, the required debt yield could change based upon, all those things. By different lenders would require different debt yield, different markets, different quality of the assets. Debt yield is really just a reflection of, it's kind of for the lender. It says, if I have to take this property back tomorrow, how much cash flow is it that I can work against? And so if you have a 10% debt yield to the lender, they could theoretically sell the property anything better than a 10 cap and come out ahead. And so it's just an easy way for them to manage their own kind of risk profile.
And I know that additional players on the cap stack, like mezzanine and like pref equity, those have yields as well, correct?
Yeah, they would have debt yields. So like right now, you can think of a Fannie Mae, Freddie Mac loan going to a 125 debt service coverage ratio. You can take many of a mezz lender will go to a 110 debt service coverage ratio. And for like true third party pref equity providers, they'll go down to like a 105 debt service coverage ratio. And so each time as we go lower to a debt service coverage ratio, we can kind of increase the risk profile, both to equity and to those people. Because, things go wrong, there's suddenly no money left for, distribution to limited partners. All right, so I'm going to flip to the next slide. I know that everyone here wants to know how they can borrow agency. Clearly, everyone's answering for this one, being funny. Come on, Sean, let's get a smile. I know you're funny. So, what does it take to actually borrow from Fannie or Freddie? Like, it's really not complicated. We want this to be very easy. You would call your favorite, agency lender, me, and we would ask some basic qualifying questions. What is your net worth? And so if your net worth is $1 million, I can lend you $1 million. If your net worth is $5 million, I can lend you $5 million. And, if Keshav and John come together to do a deal and, pool their worth, suddenly we can do $1 billion deal when you put the two of them together. And so, you can stack partners to get the required net worth. Very normal. We do it all the time. One of the things that we look for on both, acquisitions and on refinances is liquidity. We don't want you to give all of your money up in the down payment. So we want you to have at least 9 months of liquidity post-closing. So post-closing liquidity, 9 payments. That's kind of a key thing to think about. Some people say 10% of the loan amount, but it's basically the same thing. I put it in payment terms so people can think about what they're actually caring about. What's my payment? Learn that from used car sales guys. What's my payment? So credit score, we need your credit score to be greater than 700 with no major derogatory. So no foreclosures, no bankruptcies, but a very reasonable credit score for someone who's doing what they're supposed to be doing. This is the one that always confuses people. It's the chicken or the egg. I can't finance you on your first deal. And so it's very hard to get through. So you've either done a bank deal, or some other lender you've transacted with, and we then do the next deal, taking you out of your bank loan, or you partner together with your friends. And you sometimes hear the term key principal, and the key principal is a person in a transaction who's offering up their resume and experience to help a sponsor do a deal. And so that's how we help people get into the process, is that sponsors help younger borrowers get in. So that's why it's very important to join groups like this to network and make friends. And it's kind of our last slide. Thanks for kind of listening to me babble about the basics of capital markets. It's my contact info. Feel free to send me an email, give me a call. And if you're going to connect with me on socials, LinkedIn is my preferred social. Edward H. Gray, very easy to find on LinkedIn. So I know that John has been preparing for his cross-examination of me and going to let me have a bunch of questions. If anyone has any questions, please drop into the chat or Yeah, I know John and Keshav are going to ask me some stuff.
Yeah, thanks for that and great presentation. Definitely contact Edward if you want to find out more information. So a couple more questions that I did have. Market cycles. So I know we're going through a market cycle right now, and then kind of market cycles in conjunction with capital deployment strategies in commercial real estate. Could you talk a little bit about that? We can't predict market cycles, obviously, but market cycles are a real thing. So if you talk a little bit about what you've noticed in your experience in capital lending, and then how that, I guess, comparing market cycles and capital lending, that would be useful.
Yeah, for sure. I'm kind of tell a funny story. I go to Denver a lot to transact. I'm in Denver, probably 5 times a year. It's a very important market to me. And, built great relationships there. I used to do a lot of loans in the neighborhood they call Cap Hill. And then one day the loans on Cap Hill just like stopped. Like I never got another loan in Cap Hill. And then I was doing deals in Aurora, which is the next little town over to Denver. And man, I was doing a bunch of business in Aurora. I mean, just tons of deals in Aurora. It was great. And then like one day, like I stopped seeing Aurora deals. And I was like, what's up with this? Like, I thought we're doing Aurora. Like, no, we're doing Colorado Springs now. And so I started doing deals in Colorado Springs. We do a bunch of deals in Colorado Springs. Some really great properties. I mean, I love Colorado Springs. This is a beautiful place to go visit. Air Force Academy, it's great. And I kind of feel like one day, like my Colorado Springs business is kind of like dried up. And I'm still doing business with the same borrowers, but I'm doing business with them, in Kansas City. I'm doing business with them in Omaha. I'm doing business with them in Oklahoma City. And so it's kind of the market cycle you're talking about. As values changed in these places, some of my borrowers didn't change their required return profiles, and so they moved to the next market over. And so from Cap Hill, which is like the best neighborhood in Denver, probably, to the town next to it, to a little bit further out in the Colorado Springs, and then we rolled out into tertiary or in secondary markets. I mean, markets go through cycles. They go hot, they go cold. You talk about like Dallas, Texas right now, which is, just absolutely a wonderful economic powerhouse producing jobs like you couldn't imagine. But at the same time, they have, whatever it is, 20 some odd thousand new units being delivered. And so, those units are coming online and they'll all get absorbed. They always will. They all do, because booming place, it's doing great. But, there's going to be a little bit of softness in the market while those get absorbed. This kind of goes back to what I was saying earlier about apartment investing. Is it's usually a better place to be, in terms of long-term, is you don't have instantaneous liquidity. This isn't one of those things you can call, your Fidelity broker up and sell your shares and be out in 20 minutes. Selling an apartment complex is expensive and it takes a while. And so I generally find it's important to try and think through, lasting through a cycle so that you get to the other side okay. Because as you're alluding to right now where we are in the cycle, we have a lot of bridge debt that's come due, and people are frankly having a hard time refinancing their bridge loans. And so, those loans are creating another cycle, as they kind of fail, where investors will be able to come in and buy those assets at advantageous bases. It just takes a minute for that kind of to flow through. Can I answer your question at all?
Yes, thanks. Thanks for that. And I think there was a kind of an add-on question that we can piggyback on top of that, which is any success stories, notable case studies. You brought up one of them in commercial real estate, specifically any around repositioning the investments capital stack, which proved to be beneficial.
Man, one of my favorite stories, this great borrower goes and buys an asset in Hobbs, New Mexico. Y'all can all take 5 minutes. If you don't know where Hobbs is, you're not going to find it on the map, right? Like Hobbs, New Mexico buys this asset that was 62% occupied. And he and his team attacked it with vigor and effort and just did a beautiful job on renovating and repositioning that asset. And they took it from 60% occupied to full, came back to us much sooner than we were expected. And we ended up refinancing them out using Fannie Mae, putting a few dollars in their pocket. that was something that would all happen with a quick term of 13 months. That's probably my favorite of our stories. We helped some guy in a small town, take an apartment complex that wasn't the best, turn it fantastic, really good workforce housing for people. It's something you can be proud of. Like I helped create some affordable, good workforce housing in this town. It was a great deal.
Great, thank you for that. Keshav?
To our couple of last questions to get to know you a little better outside of capital markets. Along the way, we just talked about success. What are some stories that didn't go so well, and like what did you learn from those?
We once had a borrower who did not have the necessary money to close. He literally had his earnest money up and his backers hadn't provided the money in time. And, I'm laughing about because the story ends happily. And literally the last minute, like at the wide line, he was able to get the extra $250,000 needed to close, and he closed his deal. But for about 6 hours there, from the time we all woke up that morning till mid-afternoon and he got the money for the wire, I was really worried about him, like on a personal level, because these transactions in the private client middle market side, they can be really stressful. I mean, if you have, $500,000 of your money up, like that's a big pop for a person to take if a deal doesn't close. And, he literally needed $250,000 that he got basically at the absolute last minute before he lost his earnest money. That's like one that's really just sits in my mind. I mean, I'm giggling about it now, but like I really was worried for the guy, but he did it, turned out great, and he's come back several times since.
That's good. The save at the, what is it? Save at the 11th hour, something like that.
Yeah.
If you could go back 10, 20 years, what advice would you give your younger self?
I mean, I'm stealing this from Brian Briscoe, but don't wait to buy real estate and wait. I mean, it really is the thing for this. It's, time in market, interest pay down on a mortgage isn't exactly the same thing as compound interest. I know it's not, but to some extent it works kind of like compound interest, as that mortgage pays down, and more of it each day. It's just one of those things that over time, it really just, you see the benefits to it.
Yeah, that, and also fancy term, what is it? Inflation-induced debt destruction, something like that. So even though your rents track inflation, since your mortgage payments, if it's like a fixed loan, they stay constant, but over time, that
back with cheaper dollars over time.
Exactly. Yeah.
That's kind of like one of those funny things right now. Is inflation a feature or a bug, right? Like, the government who's printed trillions and trillions and trillions of dollars. I mean, I get they need inflation to be somewhat slowed down, but they get to pay it back with cheaper dollars. Are they that upset? And so I think it's, they're kind of telling us that we need to be an asset, have inflation hedges. I think that's what they're telling us these days.
Yeah. And lastly, real estate investing is great, right? For all the reasons that we talked about. But what are some things that people who are just getting into this space should keep an eye out for, or maybe have more realistic, like grounded expectations, and not avoid getting burned, on their first few deals?
Yeah, I mean, if you think about the period of time, I'm kind of calling this market cycle 2014 to today. And you could do a deal and almost do no wrong. One of my dear friends, jokes about a deal that he bought where he paid too much, didn't hit his rents, didn't hit his expenses, and still sold it at a mid-20s IRR and a 2x multiple. And you're like, that's fantastic. The deals that you do today will not nearly have those tailwinds supporting you. And so you have to just be that much more on point, much more of a well thought out business plan, thinking through how I'm getting in, how I'm getting out. I think that's really just the part where we are right now. It's just making sure that you understand the cycle and what you're trying to do. You're looking to be an LP, looking at someone's deal. On one hand, you're like, everyone says, look at track record. But, if you've done a deal in the last, 10 years, you had to work pretty hard to mess up your track record. Like you really had the wind behind you pushing you along. And so I think it's really like you have to kind of think through just at a fundamental level, like investing. Am I putting out a good investment? Are the things this is asking of me too much or reasonable? One of my other thoughts is just about diversification. If you only have $50,000 to put into real estate, like maybe we don't put it into real estate, maybe you buy a REIT share or you do something else with it. But if instead you're like, I have $500,000 to put into real estate, make $50,000 investments, diversify your bets, not put it all into the exact same thing. And that goes for business plans. Don't just invest in value add business plans that are going to, double your money, in 2 years, whatever the current thought is. You just make sure you have diversity. I think it's very important.
Great. Okay. Well, with that, thank you very much for that great presentation, Edward. And to recap some of the big takeaways from your presentation today, you spoke about different types of lenders, right? Like Fannie Mae, Freddie Mac, these government entities, HUD, CMBS, even your local credit unions, etc. The different use cases and when it might be appropriate to go with one lender versus the other. Construction loans and how you can, go from a construction loan, stabilize your development, and then get into a perm loan after that. And some of the important metrics to watch out for, right? Like cap rate, debt yield, DCR, right? Debt service coverage ratio, etc. So to learn more about all that and to rewatch this, feel free to reach out to Edward at his contact information that he included earlier. We'll be including it in the description of this episode as well, wherever you're listening to it from. And again, thank you, Edward, for taking the time out of your busy schedule to speak to our audience today. Don't forget to like and subscribe to our podcast on whichever platform you're listening to make sure that we can continue bringing you the best educational content. Thanks, everyone. And until next time, keep investing for generational wealth.